It was May 19th, 2005. In a small office in San Jose, California, a one-eyed former doctor picked up the phone and called a trading desk at Deutsche Bank. He wanted to buy insurance on bonds no one thought could fail. $60 million of it. $10 million on each of 6 specific subprime mortgage bonds. Bonds he had picked by hand out of prospectuses he had read alone at night for nearly 2 years. No hedge fund had ever done this trade at this size before. His own investors would soon try to sue him out of it. He would block them from withdrawing. For 2 years, he would look wrong, expensive, and alone. And then, very quickly, he would not. This is how a value investor who hated talking to people bet against the biggest housing market on earth, and won. The year was 2004. The American housing market had been rising without a meaningful national decline since the Second World War. Wall Street had built an industrial pipeline around that assumption. Mortgages were written by originators in strip mall offices, sold to banks in New York, bundled into pools of several thousand loans, sliced into tranches rated by Moody's and Standard & Poor's, and sold to pension funds in Oslo, Tokyo, and Stuttgart. The bottom of that pipeline was subprime, borrowers with credit scores below 620, loans that asked for no income documentation, mortgages where the first 2 years had a low teaser rate, then reset upward by 5 or 7 percentage points. The industry called them 228 ARMs. The ratings agencies called the pools investment grade. Inside this machine, almost no one was betting against it. In January of 2005, a small fund manager named Michael Burry started reading the fine print. Burry was 33 years old. He had one functioning eye. The other lost to a cancer diagnosed when he was 2. He had an MD from Vanderbilt. He had done 3 years of neurology residency at Stanford Hospital before walking away. He had never worked on Wall Street. His first real investors found him through a value investing message board on Silicon Investor, where he had posted under the name Scion since 1996. One of those readers was Joel Greenblatt. Greenblatt, one of the most respected value investors of the 1990s, had never met him. In 2000, he sent Burry a $1 million check for a stake in the management company. A second famous investor, Jack Byrne of White Mountains, followed with $600,000. Scion Capital opened for business in San Jose on the 1st of November 2000. 4 years later, Burry managed around $600 million, and he was about to put most of it quietly on the other side of the American dream. Scion's first year was 2001. The S&P 500 fell nearly 12%. Scion returned 55% net. The next year, markets fell again. Scion gained 16, in 2003 up 50. By the end of 2004, Scion managed about $600 million, up from 1.5. Burry had become, on paper, one of the best performing small cap value managers in the country. He was also one of the strangest. He worked alone. He refused most meetings with company management. He said he preferred the financial statements because the statements could not smile at him, as he put it in one of his early investor letters. And the phrasing appears verbatim in Michael Lewis's reporting. All my stock picking is 100% based on the concept of a margin of safety. The phrase came from a 1934 textbook by Benjamin Graham and David Dodd. Margin of safety means buying something for less than it is obviously worth, so that even if you are wrong, you are protected. For 4 years, Burry had applied the idea to individual stocks. In 2003, he began applying it in reverse to mortgage bonds. The reversal was simple. If there existed a bond priced for perfection and he could buy insurance against it cheaply, then the insurance had a margin of safety built into it. He had to find that bond. So in the winter of 2004, he started requesting prospectuses from mortgage bond dealers in New York. Each prospectus was over 100 pages. He read them line by line. What he found was that the worst pools were concentrated in California and Florida, dominated by 228 adjustable rate mortgages and heavily weighted toward loans where the borrower had not had to prove their income. The ratings agencies were treating these pools as statistically equivalent to earlier subprime vintage that had performed during a period of continuously rising house prices. Burry calculated that the 2005 vintage bonds would hit their first reset wave in 2007. The 2006 vintage bonds would reset in 2008. To default at those resets, house prices did not need to crash. They only needed to stop rising. By early 2005, he had a name for what the mortgage machine was doing. He called it, in his quarterly letters, the extension of credit by instrument. It is a phrase he used to describe how lenders invented ever more exotic mortgage products to justify handing money to borrowers who, by older standards, could not have borrowed it. The problem was, no one would sell him the trade. To short a mortgage bond, he needed a credit default swap. On a corporate bond, that was standard Wall Street plumbing. On a specific subprime mortgage tranche in the spring of 2005, the contract did not really exist yet. Burry spent months calling banks. Most of them hung up. A few said yes. May 19th, 2005. Deutsche Bank sold him the first batch, $60 million of credit default swaps, $10 million each on 6 specific subprime bonds he had pre-selected from the prospectus stack. A few weeks later, Goldman Sachs offered to write another $100 million. He accepted. By October of 2005, Scion's book of subprime insurance had passed $1 billion in notional. By 2006, it was over $1.9 billion. The contracts carried a premium. Burry paid the banks roughly 1.5% to 2% of notional every year for the privilege of being insured. On nearly $2 billion in notional, that cost Scion somewhere around $30 to $38 million annually. The fund had at peak about $650 million in assets. The premium was a slow leak on a small boat. Through most of 2006, the mortgage market kept performing. Burry's marks went the wrong way. The bonds he was insured against were trading near par. His investors, most of whom believed they had signed up for small cap value stock picking, began to realize their manager had spent the year constructing the largest subprime short on Wall Street. By the third quarter of 2006, Scion was down about 17% year to date. The letters started coming in. Joel Greenblatt's firm flew partners out from New York to confront Burry in person. Greenblatt himself, the man who had given Burry his first $1 million, demanded his capital back. Lewis is reporting records that Greenblatt simply could not believe his protege was doing this. Jack Burns sent word. Other partners threatened to sue. At one point, an IRS auditor showed up at the Scion office. Burry's response was not negotiation. It was legal. The Scion partnership agreement contained a provision allowing the general partner to segregate illiquid or special situation assets into a separate structure, a side pocket. Burry invoked it. The credit default swaps were moved into the side pocket. From that moment, investors could redeem their share of the regular fund, but they could not withdraw their proportional share of the subprime swaps. The swaps were locked until realized. He was essentially holding his own investors hostage to the trade. In letters, Burry told them why he was doing it. In his own words from the 2010 op-ed looking back, I argued as forcefully as I could that the mortgage market would melt down. Then he waited. The first cracks were quiet. In January of 2006, a data provider called Markit launched a new set of subprime indices called the ABXHE series. For the first time, Anyone with a Bloomberg terminal could see a daily price for a basket of BBB-rated subprime tranches. For most of 2006, the index barely moved. In late February of 2007, it cracked. By spring, subprime originators like New Century Financial had filed for bankruptcy. On July 10th, 2007, Standard & Poor's announced reviews for downgrade on more than $12 billion of subprime bonds. The ABX BBB- index lost a third of its value in 2 days. On August 9th, 2007, BNP Paribas suspended redemptions on 3 of its funds that held subprime exposure. The interbank lending market seized overnight. The European Central Bank injected 95 billion euros into the system in a single day. In London and New York, traders who had been writing Burry's insurance for 2 years realized the protection they had sold was now worth a great deal more than the bonds it referenced. Burry's marks finally turned. By the end of 2007, the CDS book in his side pocket was deeply, almost unbelievably, profitable. Through the first half of 2008, he unwound the positions one by one, selling the swaps back to dealers who now paid par or close to it for protection on bonds that were being written down to recovery values near zero. By June 30th, 2008, when he closed the Scion Value Fund for good, the math was finished. The CDS trade alone had returned roughly $725 million to his investors, net of fees. Burry personally kept around $100 million. The fund's lifetime net return from his first day in November 2000 through closure was 489.34%. Over the same window, the S&P 500 total return index rose about 3%. Burry was 36 years old. He shut the fund. He told his investors in the final letter that he was exhausted and that he had lost faith in his limited partners. Many of the same investors who had tried to pull their money in 2006 now offered to stay. He said no. Step back from the trade. This is not a crystal ball story. Burry did not have access to secret data. The prospectuses he read were public documents filed with the Securities and Exchange Commission, available for free on the EDGAR database. The ratings agency's methodology was published in white papers. The FICO distribution tables inside each deal were required disclosures. Every input Burry used was available to every analyst in New York. The structural gap was elsewhere. Ratings agencies modeled default probabilities against historical data from 2000 through 2003, a period in which American house prices rose every single quarter. A model calibrated on a world that only goes up has nothing to say about a world that flattens. The agency's stress test typically assumed a scenario of a 30% national price decline to be catastrophic and improbable. Burry's scenario did not need a decline. He only needed the growth rate to fall to zero, which in the spring of 2006 is exactly what it did. That is the deeper lesson. It is also why so few people took the other side of the market. Greg Lippmann, the Deutsche Bank trader, who eventually built his bank's own subprime short, summarized the reluctance in a phrase that Lewis captured in his book. It felt, Lippmann said, like picking up nickels in front of a steamroller. You paid a little every day to be right eventually. You were wrong the entire time, until suddenly you were not. Very few careers survived the interval. Burry's almost did not. The regulatory response, when it came, was slow and incomplete. The Dodd-Frank Act of 2010 brought over-the-counter derivatives onto standardized platforms with central clearing. The ratings agencies were placed under tighter Securities and Exchange Commission oversight. The new Consumer Financial Protection Bureau began setting basic underwriting rules for residential mortgages, rules that would have disqualified the majority of 2005 and 2006 subprime loans from being written in the first place. What did not change was the shape of the problem. The incentives inside a securitization, the originator who sells a loan, the arranger who packages it, the agency that rates it, the investor who owns it, still sit in separate rooms. Each participant is paid by the next one down the line. No one owns the outcome. When credit extends again by instrument, which it does, the same disconnect is still there. Burry's 2010 op ed, after he had been vindicated, said so in one line, which applies equally to every subprime successor since. The Federal Reserve missed it, and the mechanism for missing it has not been dismantled. For investors, the harder lesson is about conviction itself. Burry's 2-year drawdown was not wrong in hindsight. It was wrong in real time. His limited partners were not unreasonable to doubt him. A year earlier, this channel covered John Paulson, who made $11 billion on a very similar trade. But Paulson was later, larger, and better hedged. Burry was earlier, smaller, and alone. Earlier is often a synonym for wrong, which leaves an open question. If your money were in a fund that was down 17% on a position you did not understand, run by a man who would not take your phone call, would you have waited? Most answers, if we are honest, are no. 8 years after the first trade, Michael Burry would re-register a new firm called Scion Asset Management. He would take almost no outside capital. He would give almost no interviews. He would keep reading prospectuses alone at night in California, the way he had in 2004, the way he had in 1998, the way he had in 1996 on a message board called Silicon Investor. The habit was older than the trade. The trade was just 1 year out of 7.5, in which the habit compounded into 489%. Next time on Legends of Markets, a man who made $1 billion in a single afternoon by betting against the pound sterling, and the central bank that had to call him on the phone to ask him politely to stop. If you want the next chapter, subscribe. The library is being built, one episode at a time.